Welcome back to Switzer on Australia's Business Channel. Coming up next, well, not really coming up next, what we're looking at now is Stephen Halmarick from Colonial First State. He's an economist who I think knows what's going on, and so I'm going to put him on the spot and ask him a few tough questions about where the Aussie economy is going, mate. Great to see you.
Thanks, Peter. Yeah.
Stephen, you heard some of the things that Michael was talking about, but I want you to more focus on the local economy. So, but the easiest question I want to hit you with is, how far do you think the dollar would go and by when?
That's right. Well, so I've been thinking 85 cents into next year.
Yeah.
As Michael said earlier, it's really all about the US dollar. You know, so the US dollar is rising because the Federal Reserve is going to move interest rates up from zero. You know, they're finishing quantitative easing, moving rates up from zero. And so we think the Reserve Bank of Australia will be putting interest rates up after the US Fed does.
Yeah.
So the US Fed's moving first, and that means US dollar is rallying against a whole range of other currencies, including the Aussie dollar.
Yeah.
So we think around mid-80s is where we'll be heading into next year.
Okay, so sometime in 2015 you think we'll be mid-80s,
Yep.
that's your guess. I know foreign exchange is one of the hardest things to predict. And do you think then, well, when do you think the Fed will start raising interest rates?
So first Fed rate hike is in June. That's our forecast, middle of June.
You're so dogmatic about that. I thought you'd been given the mail.
No, well, I've been thinking about it for a long time.
Yeah.
I was actually in the US a couple of months ago and met quite a few senior people over there. So I think June.
Good guesses.
Yeah. The risk to that would be earlier, so March. So the Fed's gone from debating, should they raise interest rates to when do they raise interest rates? And so I'm thinking June, risk to that is a little bit earlier. Yeah. And so the Reserve Bank rate hike would be after that June timing, so in the third quarter next year.
So the critical things you'll be looking at over the next, between now and New Year, will be what the strength of the economic data that comes through?
Yeah, so the Fed rate hike is all about the data. So Janet Yellen...
She said that, hasn't she? Forget the timing.
Very data dependent.
Yeah.
The unemployment rate's been falling quickly. It's 6.1%. It's actually lower than where the Fed thought it would be at this time.
Yeah.
They think full employment is around about 5.5%, and we could easily be at full employment, that 5.5% level into the first half of next year. I guess the one area that may cause them to wait a bit is inflation is remaining very low. So their target for inflation is 2%, it's currently 1.5%, and really not rising very quickly. So that's giving them some time and space to move into that rate hike scenario.
Is that probably the only worrying aspect of the US economic recovery? You're not getting that normal inflation kick, which kind of suggests that businesses haven't got any pricing power, which undermines their confidence to invest?
Yeah, that's a big part of that, and it's really a global development. So the very negative situation in Europe is putting downward pressure on prices, same in Japan. Wages growth in the US is only very slowly picking up, and as you say, businesses are seeing that maybe do they invest or they just keep paying out dividends and stock buybacks, which of course stockholders love. They love the income. So that lack of inflation is a bit of a limiting factor and giving the Fed a little bit of pause for.
It's like the chief financial officers are in control still, and the marketing guys aren't getting a look in at this stage.
Well, I think that's right. Yeah, very, very cautious behaviour still there. Yeah. But I think there's a broadening and a deepening of the US recovery, which is, I think, a positive signal for business investment. But it's been pretty slow coming. Okay,
let's come back home now.
Sure.
There are doomsday merchants out there saying that we're not doing all that well. You want to talk calendar year economic growth, or you want to do financial year?
Calendar year is fine.
Good. Yeah. So what do you think this year will end up looking like? So
in the middle of this year, we're at a bit over 3% for the year to June. Yeah. So by December, we're probably a bit lower than that, maybe 2.75%, 2.75%. But we have to remember, this is the 24th year of positive economic growth in Australia. Yeah. No other country in the world, certainly no other OECD countries, achieved 24 years in a row of economic growth. So, we're been a long way through this economic cycle, and the big issue for Australia is the sources of growth are changing. Yeah. So you talked a lot about before. The mining investment growth is slowing. We have to find other sources of growth for the economy. Exports is going to be one of those sources of growth.
And the dollar coming down.
The dollar coming down will help that enormously. Yeah. But we also need other sources of growth, housing. So house prices have been going up massively, but we need to see house construction or residential construction, which has been picking up. We need to see more of that.
The numbers are looking okay for house construction.
Yeah, particularly here in Sydney, a big pickup in residential construction. So that will help a lot.
Creates jobs and pushes it.
Creates a lot of jobs. And the other big issue is infrastructure spending. So if we can get state governments over the line, particularly the big states, New South Wales, Victoria, Queensland, spending more money on infrastructure, that will be a huge boost to growth.
But a bit like the corporations in the USA and corporations here, governments are also watching their pennies. Governments are doing it maybe for political purposes. Some of the, I guess, the national government might be worried about ratings agencies like Standard & Poor's and Moody's. But how do they work the balance out there, Stephen? Because everyone knows we need infrastructure here, but if they do that, it increases the indebtedness. Do Moody's and S&P differentiate between the quality of debt when they look at the overall?
That's a very good question. But so to me, if you're borrowing money to buy assets, to build infrastructure, and the return on that investment should be greater than the cost of the debt, then away you go, and it really improves the productivity of the economy. The rating agencies are a little bit more, a little bit more black and white. If a debt gets above certain metrics, they put you on negative, right? Which then brings us to the point that the governments are really now trying on this asset recycling policy. So you sell some assets that are no longer needed on the government balance sheet, and you take that money and you go and build new assets. So this is what the asset recycling fund's all about.
You sell Medicare and...
and at state level, it's the ports, the electricity. So in this state, Premier Mike Baird's really, I think, pushing very hard on this asset recycle program. Sell some assets that the state doesn't need to run anymore, and build new assets, infrastructure that really increase your productivity, and your debt levels are not affected by just that switching of assets.
Do you think 2015 will, because of the dollar coming down, will help growth getting to the 3s and above?
Probably still in the high 2s.
Which is not great. It means unemployment's going to be sort of stable. It won't come down.
That's right. It's hard to see the unemployment rate coming down quickly if growth's just around trend. Trend's about 3%. So we're kind of ebbing and flowing just right on that trend level. So it's difficult for the unemployment rate to come down a lot. But let's remember that the mining sector, the capital investment in the mining sector was massive. It was up to 10% of GDP. It's coming back down to maybe 4% of GDP. So that's a big hole in growth, excuse the pun, but it's being filled up by other sources of growth. But, that transition is not easy.
And what's also interesting, Steve, is that I can remember we talked ages ago when it was like we're talking about two-speed economies. A lot of the parts of the economy that were actually struggling, they were in near recession-type growth. Like, they're actually probably better at 2.7% national growth because a lot of it's coming from retail and now tourism and education.
That's right.
They're starting to do better. But if the dollar, say, fell to 80 by the end of this year, would you pump up your growth forecast for 2015?
Well, I think I would, but I also pump up my inflation forecast as well.
Would.
So you'd get this, the cost of imports would be up quite a bit. And then the Reserve Bank, the big question from the Reserve Bank would be, well, if the dollar's down at 80 and inflation's probably above the target band, they'd probably be putting interest rates up sooner and maybe a bit harder, and that would kind of then limit some of the growth potential.
I'll terrorise them and stop them from raising interest rates too early, mate. They do listen to me. All right, so that dollar is going to be a critical issue for so many things: growth forecasts, job opportunities, and. Is there anything else out there that's either making you positive or negative? For example, the China story. What's your position on China? Michael Knox is not as negative on China as some economists. What's your view?
Yeah, I mean, personally, I think I'm more on the optimistic camp than the negative camp. There's lots of things to worry about in China. So, it's now a very large economy and critical to the world. There's probably too much debt in the property sector, too much debt at the local government level. They're trying to crack down on corruption and sort out the pollution issues. So there's lots of things to worry about. But do those things threaten the overall growth model? I don't think they do. Growth is continuing at a pace around about 7% plus, which is still pretty solid. It's enough to keep the employment growth running along as it needs. So overall, that growth rate's probably going to slow a bit in the next few years, maybe below 7, 6.5 towards 6. But that's still more than enough growth for a country like Australia, who's providing them with not only resources but services, so education, tourism, financial services.
One last one, Stephen. Your dad comes to you and says, should I stay in the stock market in 2015? What would you say?
I'd be selective, but I think so. I think the economy's probably going to do better than people think, and this transition on growth is always challenging, but it's proceeding. The dollar's now falling. The Reserve Bank's a bit on the sidelines, so I think the outlook still looks pretty constructive.
Okay, great. See you, mate. Great
Thanks.
to see you. It's Stephen Halmarick from Colonial First State. Coming up next, at a time when we're sweating on the local economy, ramping up sales and spending, we have a sales expert to explain what is critical for sales success.